Let me ask you a question. Do you actually know what's inside your credit score? Not the surface level stuff. They always put that stuff in blog posts, but not that. The real factors, the ones banks use to decide whether you get approved or denied. You see, this is what we've got to do today. I was talking to an individual last week, solid income, pays his bills on time, never missed a payment in 3 years. He applied for a business line of credit and got flat out rejected. He couldn't figure out why. He did everything they told him to do. He followed the rules. He played the game the absolute right way. And the system still said no. And that's when it hit me. He's not the only one. I talk to people every single week who are walking around confused. Good people, hardworking people, people who've done more right than they've done wrong. The truth of the matter is most people don't understand what actually moves their score. And it's not by accident. The system is built to keep you guessing. When the rules are hidden, the banks always win. When you don't know their levers, you can't pull them. That changes today. In the next several minutes, I'm going to show you the 3 factors that control over 80% of your credit score outcome. We're going to talk about what they measure, why banks don't advertise them, and exactly which lever you can pull right now. But first, there's something about how this scoring model actually works that almost nobody is talking about. And once you see it, you'll understand why everything you've tried up till now may have been working against you. Now, before we get any further, I want you to do me a favor. Like this video and subscribe to this great channel. Hit that notification bell so you know every time I'm going to upload great content just like this. Now, let's talk about VantageScore 4.0. You need to know this name because if you don't, you're playing a game with rules you've never read. VantageScore 4.0 was just approved more recently by Fannie Mae and Freddie Mac. That's critical. That means this model is now being used for mortgage decisions, not just credit cards, not just car loans, your house, your business property, your future. VantageScore 4.0 breaks your score down into 6 factors. But here's what they don't tell you. 3 of those factors control over 80% of the outcome. I'm going to say it again. 3 factors over 80% of your score. Factor number 1, payment history, 41%. Now, this is the obvious one. Pay your bills, don't be late. We've all heard that. But here's what most people miss. It's not just whether you pay, it's the pattern. 1 late payment 6 years ago, that hurts you, but it hurts you less and less over time. But 2 late payments scattered across the last 12 months, that's a pattern. And patterns are expenses. Think of it like this. Imagine you're lending a friend $10,000. They paid you back slow once 5 years ago, but they've been solid ever since. You'd probably say yes. Now imagine that same friend has been inconsistent recently, late twice this year already. You're saying no. Maybe you're saying no forever. That's exactly how VantageScore 4.0 thinks. Recent behavior matters more than old history. So here's the pro move. If you have a recent late payment, your first move is to get on the phone and request a goodwill adjustment. Be polite. Explain your situation. Ask them to remove it. Listen, do not talk to a customer service rep. Ask to speak with someone with management ability to make this decision. This works more often than you think. Same person, same habits, different positioning, and trust me, it will make all the difference in the world. Factor number 2, credit utilization, 20%. This is the one that everybody I've talked to gets wrong. You've heard the rule, keep your utilization under 30%. I'm going to say that again, under 30 because that's what they want, but it's not your goal. Under 30 is the minimum to stop hurting yourself. The real movement, though, happens when you're under 10%. That's where lenders see a disciplined borrower. That's where your score actually starts climbing. Now, why don't banks advertise this? Because they want you carrying balances when it's time for it to be reported. That's how they make their money. Every dollar you carry over that 10% threshold is interest in their pocket and a drag on your score. Here's the thing about utilization that most people don't know. It's one of the fastest factors you can fix. It's not like payment history where you're waiting years for old marks to fade. Pay your balance down this month. Your score can move in 30 days. I see it every single day. Pro move. Know when your statement closes. The balance reported to the bureaus is usually your statement balance, not your payment balance. Pay your card down before the statement closes, and what gets reported is going to be lower. Lower reported balance is a better score, much faster for you. Same person, same habits, different positioning, and it's going to make all the difference. Factor 3, depth of credit. It's 20%. This one right here is the one I see people accidentally destroy their own score with. Depth of credit is about average account age. How long have your accounts been open? How established is your credit history? Here's the scenario I see all the time. Someone's trying to clean up their credit. They see an old card they don't use. Maybe it has a small balance and they close it. Sounds responsible on the surface level, right? It just dropped their score. When you close an old account, you remove the age of that account from your average. Younger average age means lower score. I've been in this industry 37 years, and I still see this mistake made every single week. Don't close old accounts just because you don't use them any longer. If there's no annual fee, leave it open. Use it for one small purchase a year. Keep the history alive. Here's your pro move. If you have a card with a fee you want to close, call the issuer first. Ask product change to a no fee version of that same card. Same account, same age, but zero fee. You keep the history, but you lose the cost. Listen, same person, same habits, different positioning, and it's going to make all of the difference. Now, let's talk about what this means for a business owner. Because if you're a business owner or if you're trying to become one, this is not just about your credit score. This is about your funding access. Banks and lenders use your personal credit score as the first filter for business funding decisions, especially in the early stages before your business credit is established. Here's what the thresholds look like. Below 680, most lenders won't even talk to you about their commercial products. 681 to 720, you might get some approvals, but your interest rates are going to be a little higher. Your limits are going to be a little lower than what you could get at 720 and above, because now you're in a different conversation entirely. But get it, you got to get above 681. And here's where those three factors we just talked about connect directly to your money. Payment history at 41% of the score, that's your reputation in the system. Lenders want to see consistency, not perfection. Consistency. Utilization being 20%. When a business lender looks at you, they want to see someone who doesn't max out what they have. High utilization signals desperation. Low utilization signals discipline. Depth of credit at 20%. This tells the lender how long you've been in the game. A thin, young credit file looks risky to a lender. A deep, aged credit file looks like a track record. I worked with a client, business owner, 5 years in. He came to me because he kept getting denied for business credit. His score was, listen, 694. He was trying to get big money. He thought he needed years to fix it. We looked at the utilization. It was sitting at 31%. We paid it down to under 10%. Statement close date was the date we used to do it. Listen, his score moved to 724 in 45 days. Same person, same habits, but now he's got a different position, and it made all the difference. If you're looking at your business and wondering why the funding isn't coming, the answer is often right here. These three layers. Listen, the link in the description is where we work on this together. If you're seeing yourself in this, that link is your next step. Check it out for business owners. Now listen, there is an identity shift. Here's what nobody wants to tell you. The real lesson is this: your credit score is not just a number. It's a measurement of your behavior over time. And your behavior over time is driven by something deeper. It's driven by your identity. Think about it this way. Most people treat their credit like a test score they're trying to hack. They want a shortcut. They want the cheat code. But credit is not a test. Credit is a mirror. What it reflects back at you is the story your habits tell month after month, account after account, year after year. I call this the identity thermostat. Most of us have a set point, a financial temperature that feels normal to us. And whatever your thermostat is set to, you will always return to it. Here's how it works. You pay down a card, your score goes up, then you charge it back up again. You dispute a negative item, it gets removed, your score climbs, then a new late payment shows up. Your thermostat pulled you back. The credit score isn't the problem. It's the operating system. The score isn't broke. Your programming is. And the reason most credit advice doesn't stick is because it fixes the score problem without touching the system inside that created it. The truth of the matter is, sustainable credit requires an identity shift. When you start to see yourself as someone who is fundable, your decisions start to reflect that. You don't overspend the card, not because you're disciplined, but disciplined is who you are. This is important. This is the difference between people who fix their score once and those who maintain it for life. It's not what they know, it's who they are because they've decided to become someone who could sustain this. Now, what's the blueprint to get this done? 3 levers, 3 timelines, 1 score. Step 1, manage utilization. You can do this in 30 days. What do? Pull your current balances on every credit card you have. Calculate your utilization on each one. Then calculate your overall utilization. Target under 10% on each card and under 10% overall. The mechanism: VantageScore 4.0 scores individual card utilization and aggregate utilization. Both matter. Don't ignore either. The result: depending on where you are now, you could easily see a 20 to 50 point rise in a single billing cycle. The alignment note: every time you pay that card down, instead of charging it up, you're rewiring who you are in the financial system. And this is critical and important. Step 2, protect your aged accounts. This is ongoing, not optional. What do? Make a list of every credit account you have open right now. Note the open date. Note rather there's an annual fee. Then make a decision on each one. Key product change or close. The rule is simple. Only close an account if keeping it costs you more than the age is worth. The mechanism: closed accounts stay on your report for up to 10 years, but they stop contributing. The average age immediately suffers. The result: you stop accidentally destroying the depth score you spent years building over time. The alignment note: protect what you've built. It's just as important as building something new. Protect it. Step 3, build your pattern. This is the long game and the most powerful. What to do? Set up auto pay for the minimum on every account you have. Every single account. Then pay more as you see the statement date approaching when you have the ability to do it. The mechanism: AutoPay protects your payment history from life happening. It protects you from the days you're busy, you're traveling, or you get distracted. Why? Because consistency wins. Automation creates consistency. The result: in 6 to 12 months of clean payments, your recent payment pattern starts to override older negative history. The score starts reflecting who you've become. The alignment note: when you automate consistency, you stop fighting yourself and winning becomes your default. Remember this, your Vantage score ranges from 300 to 850, but the number itself is not the game. The game is knowing which lever to pull and when to pull it. Payment history, that's a long game. Start now. Utilization, that's a 30-day move. Do it this week. Depth of credit, that's protection. Start today. Credit isn't just about borrowing money. It's about positioning yourself for opportunity. And once you understand the system, you stop being a clear target and you start being the one in control. Now, if this opened your eyes to something you didn't know about your own score, subscribe to this channel. Hit that like button because we want as many people as possible to stop operating in the dark. Drop a comment below. Which of these three factors surprised you the most? Type utilization or depth. I want to see what people don't know. And if you want to go deeper, if you want to sit down and actually map out your levers, your timeline, your score strategy, the link in the description is how we do that together. That's the CBL Wealth Blueprint for business owners. And if you need credit repair work done, check that description because we work together to see things happen. And speaking of together, make sure you continue to share this with others because this is the way we all are going to level up together so that credit, business, and life begin to cause the money to flow. Be blessed. Talk to you soon.